to welcome everyone to our Momentum Multifamily live event. My name is Hayden Harrington. I'm one of the managing partners here at Momentum Multifamily, and we're super excited about tonight's presentation where you can find out how to save on taxes with multifamily apartments. So with that being said, I'm going to turn it over to my partner, Dustin Miles, for an intro and to welcome our featured guest tonight.
Yeah, I appreciate everybody hopping on. I don't know how long, Keith, you and I have known each other, probably getting close to 10 years. I'm not sure, but I appreciate you being on, and really excited. This is probably the number one topic that we get asked about. We do a ton of investor calls. I think we had a handful today, and everybody was asking about taxes. So with all that, I'd love for you to go ahead and kick it off if you want to do kind of a quick intro about yourself and then hop into the presentation.
Sure. So today's topic is about advanced wealth and tax strategies for passive investors. And I'm so glad you guys joined us. This is your time to get to ask all your free tax questions, all the stuff that is just burning you up at night. You want to know what kind of things you can do from a tax perspective and wealth perspective to save big. Now's your time to ask. So with that, I've got to, of course, give the big disclaimer. First of all, of course, so you can actually see what we're looking at. This is the presentation. The disclaimer is this is for our educational purposes only and not to be construed as legal tax investment advice. I'm going to oversimplify a lot of information to make it for comprehension. There are going to be nuances to all sorts of strategies that it's really important that you get a professional involved to actually help you do this. And the point of the presentation is to launch your passive wealth business, view your wealth as the business, and leave taxes behind. So my 60-second story is I originally grew up in California, was a CPA for Deloitte & Touche out in San Francisco, worked for them for a few years, ended up starting my own CPA firm focused on high net worth real estate investors when I moved to Dallas in 2009. Met Dustin, I think it was 2010 at the that first seminar at Lifestyles Unlimited. And then from there, along the way, I bought rental houses. I served as the director of acquisition for a hedge fund, bought 875 houses for 120 million in Texas, served high net worth real estate investors. So I did a lot of the major syndicators. So a lot of the national gurus that especially that came out of the Dallas area are former clients of mine. I ended up selling that CPA firm in 2016, largely because I could never completely get away from it, meaning I could go on vacation, but if somebody was trying to close a high 8-9 figure apartment deal, I felt like I always had to be on call. And so as a result, I did what I practiced what I preached, and I talked about how it's actually important that you save towards a goal of passive income. My number at the time was $10,000 and ended up hitting that in 2014. I syndicated some of my own deals along the way. So I had a lot more than what I needed. And so my wife and I even had a bit of friction around this. And so I ended up selling out of most of our stuff in 2016, transitioned money to a bunch of my clients. I kind of got to see behind the curtain, so I knew who was doing the best. I put my money with people who are consistently doubling their clients' money every few years. That means my portfolio did well while I was able to go out and just travel the world for a few years. And so I retired when I was 32, traveled the world, came back. Ultimately, travel gets boring after a while. There's no community. It's fun for a while, but then financial journey is about helping business owners exit their business at a high multiple and build a portfolio of alternative investments. Real estate's a big part of that. And how do you provide the cash flow to live without having to work? So it's about reaching work optional. So into the meat of the stuff, what would you have to do if you didn't have to work? What would you do with your time? It's important to run towards something, not away from something. What's the gap? What's your current monthly passive income? And what what do you want it to be? What would you do to estimate, do what you can to estimate what it would take to live the lifestyle you want to do? And so the point is to consistently focus on how close you are to work optional. The goal is freedom, not just of finances, but the freedom to live the impact you want to have, the finances you want to have. And so that's where we are from a conceptual perspective. And let's dive a little more into how this works in practice. So the point is, your wealth is the business. So many of us get caught up in making the active business what we're trying to build. And as a result, we fail to look at what it means to have our investments, our personal finances, our wealth business all together working collectively. So wealth is your primary business, reorients your thinking as CEO of your wealth business. So how much time is spent on building assets versus generating income? And as a result, so many business owners are so busy making money that they miss the opportunity to become wealthy. And so under the wealth business concepts, all your financial activities support wealth growth, including your career, your business, your personal finances, all your business income, personal income, expenses, assets, liabilities, all viewed as financial statements within your wealth business. And wealth provides the fuel to become your vision. Money itself isn't the goal. It's not that wealth is at the top, the main thing that we want. Simply that orientation means that you understand the role of all the other divisions of your wealth business company, how they all roll up and together and impact your wealth business. And so how this can play out practically is people at some point in their life, they might be building a business and they're growing, and they never stop working on building, and they never transition from building to living. And so as a result, I've met guys who talk about how they worked into their 60s, 70s later, and they never got a chance to really enjoy their wealth. Instead, if you realize that, hey, I can transition in at age 40 or wherever you're at, you already have enough of a wealth business to maybe you're working at systematically investing that money in a passive portfolio of investments, possibly with Momentum Multifamily. That means you are over time building up that passive income. And at some point, you're able to leave your active business and you focus on building the ROI of your wealth business, meaning you take a more active role in your passive business. That's going to sound a little funny. And what I mean by that is you're working on due diligence, you're working on your deal flow. So everything that you need to do to help increase your average rate of return and lower the risk as part of your alternative investments is how you're going to grow that. So when you're first beginning in your wealth business, if you were to save $1,000 at 30% ROI, is going to make you $300. Not going to make a whole lot of sense. But if your income's $300,000 a year, and you have a $2 million portfolio, then a 30% ROI is going to be $600,000. So maybe at that point, it makes more sense to focus on your investments and let go of your business. And so at that point, you're either making your business more passive, so you have a board level role in your business, or you're selling it for the highest multiple possible and taking that money and further feeding your investments. So concentration versus diversification. I'm sure you've all heard of diversification. What's most important to focus on and when? Concentration is when you're investing your time, your energy, your skill set into growing something, one particular thing. And that's how people are able to grow a business really well. So nobody looks at a business that they're actively working on and think, you know what, in the beginning, I grew it by 10%, 20%. That's not so important. You really need exponential growth in a business when you first start out for it really to take off. That's how big businesses like Amazon, Facebook, etc., really take off. That's probably the biggest way to make a lot of money quickest. That's the way to do it to make the most amount of big money. It's also the riskiest. The next way after that to make a lot of money is to go into real estate. There's ways to either invest passively where you're investing in the best of somebody else's efforts, or sometimes you even decide to syndicate because then you're able to get leverage from banks and other investors, and that's a way to go quickly. My favorite way is to buy into other syndicators who are really doing well. I get a piece of their little economic pie that they're growing, and I don't have to put in the effort. And it means my portfolio continues to take off way better than traditional investments. So in the beginning, I concentrated my wealth, concentrated my time in my own syndications, my own business. And later, I diversified when preservation of wealth was more important, when it was more important that I maintain my assets and maintain my lifestyle. Frankly, I'm not interested in doing as much active growth because I like my lifestyle as it is. And I've got Financial Journey is a wonderful hobby business that I get to work with people, and it's more fulfilling for me to keep it where it is. So another key point is double dip assets. And what I mean by this are equity growing assets with cash flow. So with double dip assets, there's two ways you make money, both through the equity and through the cash flow. And this is just a great way to start. The equity growth provides future capital gains and favorable taxes, and it's a hedge against inflation. Cash flow will help pay for your lifestyle expenses so you can leave active work, and it gives you options, time and options if the market is down. So a positive cash flowing asset like a rental house, the value of the house might go up and down a little bit, but as long as it's positive cash flowing, you don't have to sell. You can hold it indefinitely. And that's why it's a great protection. So the cash flow, like I said, provides your lifestyle expenses. It lowers the risk because you don't have to sell. You can hold on to it for a longer period of time. Cash flow is usually taxed more at ordinary rates, maybe higher tax brackets. There might be some ways you can offset that through depreciation. I'm going to dive more into that in a little bit. Your equity growth, that's what's going to build wealth, the inflation hedge, and your double dip assets is where you're able to get the best of both worlds. So in practice, a few asset classes on how this works out. Cash flow, strictly cash flow, going to be your bonds, your lender loans. Maybe you're into hard money lending. Many service-based businesses only provide cash flow, and there's less opportunity for you to actually grow equity in a way that you can sell. Versus equity growth, these are non-dividend paying stocks. You buy something, maybe like Tesla, and you just hope that it'll go up. Yes, it might do really well, or Bitcoin, traditional purchases of cryptocurrency. It's going to go up, and that's your bet that it's going to do well. Land, your personal home, startup businesses, those are all hoping that they go up at some point and you're able to sell. Double dip is where you're like dividend paying stocks. You get a measurement of cash flow. You can always calculate a cash on cash return to decide if things are a good value. Rental houses, apartments, businesses with strong systems with IP, or you've got equipment like assets or manufacturing. All those are ways to build equity and cash flow as part of that business. So from a deal pipeline perspective, is your investments, are they a trickle? Are they steady? Are they flood? So depending on how your deal flow pipeline is, the more you can grow this, the more options you have. I'd like to have a steady stream of deals coming to my email box so that whenever I have money, when I'm looking ahead and I'm thinking, okay, this deal's paying off, I'm going to be getting $100,000. I'm already looking ahead to think through how I want to deploy this. How is this going to fit into my portfolio? Am I too concentrated in a certain investment type? Do I want more of something else? Where can I find, so by having a consistent, great deal flow, I'm always picking the best of great investments rather than just trying to pick something that I think might work, and it really helps. So where do you get these deals? So Momentum Multifamily, you're already in a good spot. You can go to money managers like financial advisors. You're going to typically have lower ROIs and higher fees. There's various syndicators out there with strong networks. I love finding great syndicators that I can trust. Your network, there's private clubs that you can invest in or cultivate relationships with other people. I will say, as part of being a syndicator, whenever I get into a deal and there's a party, a Christmas party, some investor event, one of my favorite things to do is go around and talk to all the other investors and say, what great deals have you invested in? And when you start hearing people who are consistently giving certain names that have had success, those are the people who I want to start invest with. And then it's not just somebody who's pitching you on something, it's other passive investors, other peers who are saying they've had success with people over time. And that's how I love to find great deals. You can go to different professionals in a niche. So you can talk to the accountants, lawyers, lenders, and contractors and ask them, who would they invest with? You can go to trade shows when you see the one guy who's winning all sorts of awards because he's grown his portfolio or provided great returns or created a great community, maybe the apartment association. Those are the people who I might choose to invest with. There's different investment clubs, from everything from RIAs to incubators to angel funds, investment education groups and websites. So this is where it's really helpful to know what options are available. And that's some of the stuff I talk about in Financial Journey. Is I share the best of my deal flow, and I have clients, I show them how to bring out the best of their deal flow. And you're consistently getting the best deal flow from the community rising to the top. And that's one way we pick some of the best deals. I think it's important to have your money, to put your money back to work before it even hits your account. So in my case, I had this last week, 3 deals pay off. They all came at once. When it rains, it pours. And so now I'm sitting on a lot more cash than I normally did. But in the few weeks coming up to that, I knew about when this money was going to come in. So I already had a plan to deploy them. So I've got the money going right back out the door this week for a couple deals. And the rest of the cash I expect to be invested very soon. And by I put it back to work as quickly as I can, do proper due diligence and verify those returns so that my money's not sitting idle, losing 5% annualized in inflation. I think the CPI index is flawed. We might even see in hindsight closer to 7 to 9% inflation. Everybody in the 70s, nobody would tell them at the time they were losing 10% of their money each year due to inflation. But hindsight, history shows us it did. Cool. Investment vehicles. So I will do a high level overview on each. There are other times I can go really in depth into each of these. And as you guys go, ask questions. There are a lot of questions I'm already seeing coming in. I'm going to take a good amount of time, especially at the end, to do Q&A, run through all the questions in the chat box so that I make sure that everybody's taken care of. So different ways to invest. There's your personal name, or even through an LLC as a holding company. And there's through an individual retirement, a 401k, infinite banking. This is the overview. I'm going to go into a little more depth in each of these. The point with all of these options is that you self-direct. So anytime you hear any of these options, I want you to know that there are ways to invest in real estate, private lending, cryptocurrency, private businesses, your traditional brokerage account. You can almost invest with anything if you know the right provider, custodian, or method to do it. So don't feel limited that you can't invest. I'm sure anything that Dustin's presenting, you can invest in. So personal name. Anytime you're doing it in your personal name or LLC, directly in your personal name, it'll provide simplicity, and it'll help decrease your liability. Now, it'll increase potentially its maximum simplicity and maximum liability. When you invest passively through an LLC or typical syndication, your chances of something going wrong with the deal itself, your liability is pretty limited. There's little chance that you're going to have something come back. What can sometimes happen is when a deal goes bad and investors are expected to kick in more money, or in a syndicator, something's a little fishy. That's when you can be expected to kick in more money. And that's where there can be lawsuits between investors and the company and stuff. It hasn't happened very often. I know some deals, I've even been a passive investor in some of the stuff when it's gotten really ugly. For the most part, we've been in a rising market environment for a long time. And so the number of deals haven't had a chance to go bad because appreciation has saved everybody. And so those who really dial in their numbers are the ones who are going to do best through the next market cycle. So the point I'm trying to make here is having an LLC that you invest in might provide a little bit of additional protection. And those LLCs can be taxed as disregarded entities, partnerships, S corps, C corps, all sorts of different ways out there. And just to give you a quick idea what I would choose or not choose to invest in, disregarded entity simply means it's in your personal name, meaning that you've got an LLC, you invest through that LLC, but it flows through your personal tax return, no separate tax return is filed. And it's simply a great way to limit your liability, and it still provides a lot of flexibility. And doing stuff through your personal name is going to have typically a little more audit risk from an IRS perspective than doing it through an entity. So last time I looked at audit risks, if you're making between $200,000 and $1 million, you had like a 2.7% chance of being audited. If you did that same activity through a partnership or an S corp, you're looking at 0.4% chance of being audited. So a 6 or 7-fold decrease by simply running your activity through a partnership or S corp. I love an LLC taxed as a partnership for like an investment holding company. So my wife and I are partners, and we'll go invest in stuff. And it means through an LLC, my personal social security number is not out there. My EIN number is out there instead. So there's a little more protection against identity theft. I don't know of many syndicators that mishandle. I don't know of any syndicators who mishandle their investors' information, but just the less places my personal social gets out there, the better I feel. So partnerships are good for owning real estate, but are bad for any sort of an active business where there's like payroll taxes. So an S corporation is great for payroll taxes, for limiting payroll taxes once you've paid yourself a reasonable salary, but terrible for owning real estate long-term. If that's really interesting to you, maybe I can dive into why corporations are bad to own real estate long-term. You can put that in the chat box, but the short version is not something I'd want to do own real estate long-term in any sort of a corporation. C corporations these days, they're not as often used except for either large corporations or specialized situations like software startups, and you're going to have a lot of ownership, or ROBS, a rollover business startup plan, where you use retirement funds to fund a business, and most of that money goes back into your retirement fund without triggering any sort of UBIT. C corps can be used to avoid UBIT, meaning you pay taxes at the C corp, and then it goes through to the investors at no taxes, or as a benefits corporation. So sometimes people who have employees have trouble getting benefits for the owners that they only want to provide to the owners, and so there's special situation with C corps where you can do that. Retirement accounts, 401k versus IRA. So 401ks, almost always, I prefer 401ks over IRAs. I have trouble thinking of any scenario I would ever prefer over an IRA unless a 401k just wasn't an option. So 401ks can also be solo 401ks. So if it's just you or you and a spouse, you can set up your own 401k plan real easy. You can still use 401k for investing. You're supposed to include your employees, but there are ways. I've got professionals I work with who will custom write a 401k plan for you and your spouse, and there are different ways to legally exclude employees, or if they're not accredited investors, maybe they can't invest in the same investments, or maybe you don't mind. So there's different ways to look at that. That's a whole nother deep dive on the topic. I just wanted to let you know that's possible. It just costs a little extra money, like $5,000 to $10,000 to write custom plan, versus a solo 401k can be under $1,000. So with a 401k, you're able to contribute $58,000 to $64,000 a year in money into your 401k account. We're going to talk more about that in a second. Your prohibited transactions, if you make a mistake, you get a 15% penalty on the amount you invested, and maybe the investment is distributed. Versus an IRA, they distribute out 90% of the entire, they distribute out the entire IRA. The whole IRA is killed, kaput, nuked, and you lose about 90% of the IRA balance due to a mistake. So having a prohibited transaction in IRA, way worse than a 401k. You're also much more limited on what you can put in an IRA. There's no UDFI or UBIT. UBIT is unrealized business income tax. And what that is once you've had $13,000 worth of income inside an IRA, like you invested in real estate, then you can be subject to UBIT. Like any sort of a business that you invest in, like a restaurant, a golf course, a hotel, those are all active businesses. So as a result, The moment your income from the investment goes over $13,000, you're at the highest tax bracket possible of 37%, 20% capital gains rate. It's terrible. Your IRA actually has to file a tax return. It's called the 990T. You can look it up. And that's why I think it's a terrible deal. And a lot of syndicators either aren't familiar with it or they're not really supposed to be talking tax strategy with their investors anyway. That's why I'm here. So you can avoid all that hassle by simply doing it through a 401k. If you're on real estate, there's still UBIT on 401k, but not the unrelated debt financed income. So if you're investing in apartments through a 401k, no UBIT, you're good. So simply changing the account type, huge win. 401ks are statutorily exempt. You can also get a 50K personal loan, adds a little flexibility. You can use the money sooner without penalty. You can also convert an inherited 401k to a Roth IRA. So I know I have several clients who are working with their parents to build up these 401k accounts. They've even, in some cases, put their parents on payroll or worked with them, depending on their situation, to get that. So lots of options. Also want to point out that you can retire at any time. Anybody who says, you know what, I don't want the government waiting to tell me when I retire. I had that mentality for a long time. I built up a large enough personal portfolio. Now I'm going more for tax efficiency. And so I'm more okay with putting stuff in the 401k. So you can look at, if you're 40 and you have a large enough retirement plan now, you can look at what's called substantially equal periodic payments, AKA Section 72T distributions. And those distributions are based on the life expectancy. So you've got to pay them for at least 5 years or through the age 59 and a half, meaning you've got to have enough balance to fund to keep your retirement going. There's no penalty on those distributions. Infinite banking. This is taking whole life insurance and you can almost put in unlimited amounts. I'm going to asterisk that and using loans against it. So I've got to admit, I was very incredulous against the infinite banking concept for the longest time because there were really high fees. It took like 10 years before it started making sense. You paying in premiums before you actually saw a positive return on your money. The way things are structured these days with the provider I'm working with now, it's 2 to 3 years before I receive a return on my money. I've even had a client that it was 1 year. He was now positive. It was a good deal for him with infinite banking. So how does this work? Let's say you invest $50,000 a year for 10 years. That's going to work out to $500,000. Over time, that grows. You're typically getting a 4 to 9%. 9% has been the average ROI for the last couple of years on your return. So your that 4 to 9% growth, not too terribly exciting, but it's steady. You get something. So let's say you've got that $500,000 growing at 4 to 9%. But on top of it, you can withdraw 95% of it and do whatever you want with the money. You can pay for your kids' college, you can fund your retirement, or you can go invest it. So one of the ways the ultra wealthy avoid taxes is they don't have taxable events, meaning they own a lot of land, a lot of things with capital appreciation, and they take a loan out against it. And then when they die, their heirs get stepped up basis. And so they fund their lifestyle with loans. They go into debt to fund their lifestyles, and they're cool with it because they get these low interest rate loans. Infinite banking, same concept. You can make, if you have your policy continues to grow, you can pull money out and invest it. And because let's say you're investing it at 12%, then your real estate portfolio grows. You're able to use 95% of your money you've been putting into your real estate portfolio. Plus you're still getting the 4 to 9% on top of it. So it's the mixture of that 4 to 9% growth on top of the 12% maybe you're getting from real estate that allows it to really grow really high. And so let's just kind of comparing the different deals. I ran a lot of spreadsheets. I was skeptical of this infinite banking concept, but I'm going to show you my numbers. I'm 36 right now. So let's say you start at age 37 and you invest, this is based on my policy. So if I invested $50,000 a year from 37 to 60, and then I had a guaranteed $15,000 a month coming out from age 61 to 90, plus the balance will continue to grow. So if I did that all in my personal name, I'm paying taxes. In my guesswork, I said, I'll pay 20% tax rate each year just to have a number. on whatever the growth is. And so you can see my result if I actually live to 100, 117 million. Infinite banking, I'm at 175 million. Roth, a Roth 401k, I'm still best. So that's why 401ks are still my favorite option. But infinite banking is up there too as a strong consideration and in my top 3. So all these different investment vehicles, what should you choose? I like to match the vehicle to the asset. What are you investing in? So your ordinary income is best for tax deferred accounts. So this can be a Rob. So if you're looking at doing a new startup and you want to grow your 401k account quickly and you've got energy, willing to start a business, start a business in a C Corp owned by your 401k. And because of that, all the profits of the business, there's no UBIT. It's weird and unique in this way. All the profits of the business can quickly go into your 401k and you can turn around and invest it in other things. There are, if I'm going to do real estate, like flips, wholesaling fees, anything with short-term income or like sales income, ordinary tax brackets, stuff that's taxed at ordinary tax rates like 37% or potentially 39.6%. That's what I'm going to do more in an IRA. More stuff that are like sheltered, more like long-term capital gains, or when there's strong tax deductions like depreciation, like real estate, long-term holds. That's where I'm more likely to do it in my personal name, LLCs. These are all rules of thumb, not written in stone. And so I wrote stocks frequent trades here. This should say long-term holds 1 year plus. Cryptocurrency, of course, 1 year holds as well. Oil and gas is also a great way to get great investments. They're not popular right now, which is why they might be a good investment. So moving on to 401k strategies. How do you quickly grow wealth in a 401k? So self-directed 401ks for business owners, and we're going to talk about discounted rollovers and how to move money from a traditional to a Roth at a super discount. So Mega Roth 401k. This is how to supercharge your 401k. You may or may not have heard about this. It's finally getting out there. Even after years of talking about this, it's finally starting to gain in popularity. You can look it up. You'll see a lot more about this. Traditionally, your financial advisor, your employer is going to tell you you can't put in more than $26,000 a year. They just don't know about this strategy yet, and you can go educate them and show your financial advisor something. So you can put in a 401k. If you're under, I think it's 55, you can do the first 19,500 goes in as a traditional 401k. The employer puts in another $6,000. You can do as an employee, if my 401k plan permits it, I can cut a check of $32,500 in after-tax contributions to a Roth 401k. You can also have a 401k account that's owned by, you can have one with an employer. You can also start your own business. If you're employed somewhere, you can start your own business, pay yourself something. If you're making money, then you can start contributing to your 401k in addition to your employer's 401k. And a lot of employer plans aren't written to allow for the after-tax contributions, but if you own your own business, you can write the agreements however you want. So in that case, you can go ahead and make this allowable. And so what this does, it allows you to put out $58,000 a year, and you can do it per spouse. You can put your spouse on payroll if she's contributing, and between the two of you, $58,000 a year, that's times 2 is $114,000 a year. Plus you can do multiple companies with this. You got to split up the control group. That's more of an in-depth conversation. But I knew a guy who contributed $1 million to a Roth 401k 1 year because he got really hyper-focused on how to grow it. And so the point is, how much do you want? For most people I talk to, putting in $100,000 a year into a Mega Roth 401k is plenty for them. And so if you have employees, it complicates the matter some, but it's still possible. Cool. Strategic rollovers. This is one of my favorite things to do, and it's a huge thing, especially for apartment syndicators to offer to investors, or for you to bring to the attention of your apartment, your syndicator that you want to invest with. So Dustin and I have been talking about this. I'm sure he'll have a great opportunity to do this soon. So the way it works is we're timing the rollover of an investment. So let's say you put $100,000 in with Dustin and Hayden in a deal. They bought it at 80% occupancy. There's a major rehab as part of this. They have to kick out some old tenants and they're going to renovate some units. So the occupancy is going to drop from 80% down to 60%. So maybe as a result of it dropping, the net operating income is going to drop in half. So temporarily, since apartments are valued based on the net operating income, your investment has maybe dropped in half. So your $100,000 investment is rolled over at a $50,000 valuation. You're rolling over the investment, not the cash, from a traditional account to a Roth account. This can be IRA or 401k. And from that point forward, since you invested with Dustin, it's going to pop up in value from $50,000 once they finish the rehab, they lease it up, to hopefully being worth $150,000 or $200,000. So what's the effect? You went from initially you contributed $100,000 to a traditional account, and so as a result, you got a $100,000 write-off against your adjusted gross income on your tax return or indirectly through your wages. Secondly, you're going to pay taxes on $50,000 when you roll it over. So the two can net out if you do them in the same year, and it's going to pop up in value. So since it's in a Roth, the distributions are never going to be taxable again, versus had you kept that money in a traditional account, you'd be paying taxes on that $200,000 you're withdrawing years later. So how cool is this? I think it's a way with a little planning to really do a lot. As part of this, usually the syndicator can hire like a CPA who's going to do this valuation anywhere from $500 to $5,000. And once the valuation is done, they can copy and paste it across all their investors. And so it's a way to add a lot of value to a lot of people, and it doesn't really cost a whole lot for what it is. You can also do controlled discounts. Some of you might be familiar with family limited partnerships. It's an estate planning tool, or lack of marketability, meaning you can't easily resell your assets. So how does this work in practice? If you have $1 million cash sitting in a family limited partnership or a deal you just invested in, is it worth $1 million? It sounds like it's $1 million cash, probably worth $1 million. But if I'm a creditor and I don't have control over the assets anymore, and somebody else is the manager, and I don't have the power to make distributions, the manager of that asset can say, hey, we're going to give you K1s for the next 10 years and not give any distributions. So you're going 10 years with just paying taxes, but you're not actually having to get any cash out of it. Then maybe that $1 million cash, because you can't touch it for 10 years and you've got 10 years of tax bills, isn't worth $1 million. Maybe it's only worth $600,000 or $700,000, or you can't easily resell it. So you can invest $100,000 day one, and then day two, maybe you roll it over at a 30% discount or something like that, so that you are, because you're not going to be able to touch it for 5 years and you don't know exactly what's going to happen with the investment. So if you do controlled discounts with strategic rollovers, you're looking at 30 to 70% off on your rollover. So that $100,000 you invested might only be a $30,000 rollover. So Roth, if you're able to use Roth accounts over your life, that's going to mean 2 to 5 times wealth growth over your lifetime. And with the discounted rollovers, I think it makes a lot more sense in how you're able to roll things over. You're not just paying ordinary taxes at the highest tax rate for these large sum of money. When you see opportunities to do these discounted rollovers, you can make a lot of money quickly. And this can be IRAs or 401ks. I'm going to be wrapping up here in a moment, and I'm going to get to all the questions. I see there's a lot I can answer. So the 401k, one of the ways I've seen this really play out is, as a CPA, I had a client who was 40 years old with a little over 40 single family rental houses in his 401k, in his Roth 401k. He never had to pay taxes again. He kept a small business going, making, it could be a few $1,000s a year. And that was just for the sole purpose of having a 401k that he could maintain and never pay taxes. He didn't have to worry about unrelated debt financed income. He didn't have to, he had some, he actually didn't have any loans on the property, but I've seen others who will do lend loans against within a 401k. And so the strategy of a 401k accomplishes 5 goals. Your traditional contributions reduce your ordinary income when you put it in, so it pays to save. You've got the valuation discounts on the conversion and in the tax-free accounts. Your investment growth happens without the IRS taking a bite of your taxes each year. Future fund distributions are never taxed again, and you receive the benefit of an ordinary tax deduction as you're putting money in. And so there's a hybrid between the two, where I love to put money in at the ordinary tax deduction and then get a rollover at a discount. And so you've got $100,000 in, $50,000 taxable event, you're still coming out ahead with some good planning. So this is like not your average 401k account. It's a plan on steroids. So I'd love to understand what resonates with you out of all of this. If you don't mind, real quickly, chatting in the box, what have you guys been most excited about? And then we're going to run back and try and answer all those questions. So Rob's came up. That was interested. Kathy was interested in that. Yep. Cool. I think that was the only thing people were interested in, apparently. Lots of questions, though. This is meant to be interactive, so I can actually see and talk to you guys. Infinite banking, cool. Using the company to add to your already maxed out 401k. Yes, you can do a 1031, but certain conditions. We can even talk about opportunity zones if you guys would like. Tons of stuff to talk about. I know we've only got one night together, so we will make the most of our night. Cool. With that, I am going to transition here and just start talking through all the other options that we see. So I'm going to start at the top, or if Hayden or Dustin want to field questions, I'm happy to do that and just make sure that I'm asking, I'm not missing anything. How do you avoid UBIT, UDFI for IRAs? 401ks, the easy answer. You can also do it for use a C Corp as a blocker. A lot of that is very situational depending on what you're investing in. How can I stay at home? How can a stay-at-home spouse qualify to become a real estate professional and help with the other spouse's high active income? So if you have one spouse has a job, in order for that person to qualify as a real estate professional, they work 2,000 hours in their job, they'd have to work 2,001 hours as a real estate professional. But if you have a spouse staying at home, you need at least 750 hours, as a real estate professional to qualify. And so if you're able to, that person is able to do 751 hours is actually working in the real estate business, that's how you're able to do. And I see actually Michael Porter put in a answer to that from Google. Thank you, Michael, for answering your peers' questions.
Keith, just to add to that, because we get this question all the time, could you give maybe some examples of some real estate activities that would qualify?
Yeah, so it's important that it's not just investment activities. So if you're doing due diligence on an apartment syndication deal, just as a regular investor, that's not going to qualify. But if you're doing more active roles like driving the property, looking at anything from bookkeeping to administrative, taking calls with renters, rehabbing the property, anything that's above and beyond just a simple, let me check out the deal, do a little due diligence, that perspective is what's going to help qualify that. Something where somebody's truly active in the business, not just turning it over to a property management company.
In terms of multifamily and qualifying as a real estate professional, would they need to be on the GP side and have some sort of role, or where does that?
Yeah, so this is a multi-part test, and that's what's confusing and why a lot of CPAs will even confuse this. So you've got the 750-hour requirement, you've got the material participation requirement. There's a third one as well, and so and that's where some of the complexity comes in. And I'm not going to kill this with the complication. I'm going to shorten this up and say you need to either be spending 500 hours in the project per year, which is really tough to do as a syndicator, because sometimes the syndicators might not even hit that requirement. But if nobody else is doing as much hours as the syndicator, the main guy, if the syndicator is not hitting 500 hours, then it lowers down to a 100-hour threshold. So the syndicator needs to at least meet the 100-hour threshold or be like the primary guy in the deal. And so as a result, the passive investors need to match at least that hours requirement or the look and feel of stuff. So one way you might make the argument is if you're a principal in the deal and you went out and you helped with due diligence and the lease audits, or have some, or you're working for the GP in some capacity. Being employed by the GP certainly helps that. It doesn't guarantee it, but if you're employed by the GP, you're likely going to qualify as a real estate professional. It's just tough for all the passive investors to keep up with that same requirement. Can you 1031 from single family to multifamily? Yes, you can 1031 from any like property, which is any real estate, to other kinds of real estate. So you could do single family to land, to hotels, to apartments. They're all considered real estate. And so you can 1031 from any one of them. The challenge is you're supposed to have title. If let's say you personally sold a rental house and you're trying to 1031 to multifamily, if you're trying to 1031 into Dustin's deal, he would have to allow the same entity you own the single family property in as ownership in Dustin's deal, or do what's called a TIC agreement, a tenancy in common agreement. And that's an extra complication that most syndicators aren't going to want or allow to have. And so it can work if you got like typically less than 5 investors, then you can do that into multifamily. Can I paint a picture on depreciation on a multifamily investment? Yes. So when you first take over a property, there's a bunch of things that you can do. And under current tax law, it's starting to fade out the amount of accelerated depreciation you can do over the next few years. But you can write off your appliances, your carpet, your fence, all the 5, 7, and 15-year assets, your 15-year property, the pool, the pavement, the parking lot, the signpost. There's a lot that you can get an immediate write-off of at 100%. And so especially in the last 4 years, you've been able to do a cost segregation study that takes your purchase price and breaks it down to all these different assets, and you can get a huge amount of depreciation back. You can also do partial dispositions, meaning you disposed of the roof because you got rid of the old roof. So, and you're putting on a new roof, you can get an immediate write-off for the value of the old roof. And so there's a bunch of levers you can do. I can pull up a quick, there's a few extra things I threw in here just to, how do you manipulate your apartment tax bill? I'm going to take my face off the screen so you guys can actually look at this. So you've got everything from cost segregation studies in the year do it. You've got accelerated depreciation. On the 5, 7, 15-year property, you've got partial dispositions when you're writing off a big chunk of the old roof. Whenever you're disposing of old assets prior to sale, you can write off stuff that you've gotten rid of. You can specially allocate the sales price, meaning if you have there's a lot in here. I can go into detail, but I'm feeling like I might be starting to overwhelm people. So I'm going to kind of pause here, and I'm happy to go into more questions if people have it on stuff that they want to know about. There's a lot you can do from a depreciation perspective. It can often be 40 to 60% in the year that you buy the property. How do we work with you? So I don't do tax prep anymore. We'll still do tax strategy as part of my clients. If you want to connect further, I'm happy to share my information and have people reach out to me. But my real focus is helping people build wealth and get out of their business, make it work optional, and tax strategy is simply part of that. Are there any questions I'm missing, Dustin? There's been a lot that have been put into the chat, and I don't want to skip it.
Yeah. One thing that I know someone had messaged me about was, and I know it could be a rabbit hole, so I know it could take a while, but if you wanted to kind of touch on opportunity zones.
Sure. Here's the short version. Let's say you have $100,000 in capital gains right now, and as a result, you would like to at least defer paying the taxes on it. So you've got $100,000 capital gains in 2021. You can invest that money in an opportunity zone project, and you get a 10% discount on the capital gains. So in 2026, that year comes up. It was something with the Trump administration. Without going into detail, you would have to pay you get a 10% discount on the $100,000, meaning you get $90,000 that you have to pay taxes on in 2026. And then the appreciation of the project is never taxable again, meaning you invest that $100,000 into a project, and as long as it's in it for 10 plus years, then maybe it appreciates to $500,000 as a passive investor, and you're never having to pay taxes on that appreciation. And I've got a quick slide on this to kind of give an overview, especially if you're watching the recording. You can go back and look at this later. Oh, I think my note is saying 5% now. Yeah, I know that was dropping. So the main point is you're investing in a project in certain zones that are economically depressed. They're set by the government. And so either has to be a major rehab where you've got like 50%, you're putting 50% more funds in than what you originally invested, or you're starting a business in that zone. And so it doesn't typically work for traditional multifamily rehab, but if you've got like a major project that needs a major breakdown and reconstruction, that's where I think it makes more sense.
Got a question here from Aaron Kelso. It's a multi-part question, so I'll ask the first part. He asks, if your company matches a 401k contribution, can this be transferred to a multifamily investment as a passive, or is this only through self-directed IRA?
Your company is unlikely to allow you to do self-directed investments. And so that's why when you leave a company, it often makes sense to roll your funds from a traditional 401k to another 401k. It is, you can roll like Roth 401ks to Roth 401ks. You can't roll Roth IRAs to Roth 401ks. And so be hesitant about putting money into the Roth IRA. I'd rather put it in a Roth 401k instead.
Awesome. And then for those accounts, do you get penalized if it were to be taken out before, say, turning the 59 and a half years old?
Most of the time it can, but with a 401k, you can, if you retire early and you do the 72T distribution, you can start at age 40 and there's no penalty on pulling it out. You can pull money out of a Roth and the principal is not ever taxable, and the growth stops being taxable after you can be pulled out penalty free after 5 years. You can also, I love as my preferred account for kids, you can start giving you can take your 10-year-old, put them on payroll, get them a 401k account now. And that's my preferred savings account because they can pull the money out for college, they can use the money for a house, or they can just wait and put it in for retirement. And the whole point is with compounding, if you start a 10-year-old now with much money, they are guaranteed to reach financial freedom by age 60 simply through compounding. They don't even have to do any fancy investing.
Tom had the question about the K1 depreciation. I know anyways, basically to offset long-term capital gains for the tax year.
Yeah, I'm trying to, yeah, will your K1 depreciation offset your long-term capital gains? But yes, it can. And there's this yes, the short version is yes, without going into a whole lot of detail. So that's actually one of my favorite ways. So typically as a passive investor, you have a tough time using passive losses from real estate apartment investments against your earned income. And so it'll definitely offset your other passive income. It may be possible. Some people get really fancy in creating control groups where they'll group other real estate activities with their other passive investments. It's a gray area. It might still be possible. The IRS hasn't made a definitive ruling on it, and which is why some people will talk about it. A lot of CPAs will say no. And I'll just tell you, it's a gray area. And I didn't used to allow it as a CPA, but I've since talked to some other tax attorneys who seem to think that it's okay, while I talk to others that say no. Also, do I recommend any self-help books on our education on this? Can you talk through balance on? So I don't. So if you want to go deep in IRA education, John Heyer is a favorite tax attorney of mine who's really big on this space. And so he's got a monthly call that he does on all sorts of tax topics, and he's more real estate focused. And so he's a great place just for general education. In terms of where do you find great tax strategists, I struggle with that. Where do I refer clients to? So last month, I actually started a mastermind group strictly for tax preparers to turn them into tax strategists, just so I could have more people to refer clients to, since I only do the tax strategy now. I only work with people on as a complete holistic package. I'm not interested in just working on the taxes, but I'm happy to do that as part of the full package. And connect with me further if you're interested in that. If your company matches a 401k, can this be transferred to a multifamily? Nope, we answered that. There was also one, when you convert from a traditional to a Roth at 59 plus a year, and plus the penalty, what about the taxes bridging the gap if you're already passively invested? So traditionally, you don't want to move money from a traditional account to a Roth, especially over about 50. However, I think if you're doing at a significant discount and you're looking at the math, especially if you're in a strongly appreciating deal and you're paying taxes on $30,000 to $50,000 on the rollover and then never paying taxes again, and it's got a strong value add, I think there's a strong case to be made that a Roth can still be a good idea. There is no one size fits all strategy, and this is where it's helpful for you to look at the numbers for yourself and decide whether or not it makes sense. How do you defer taxes on capital gain and use it for real estate? So there's a whole bunch of ways to defer money, to defer capital gains. And so my favorite method is to actually wipe out my ordinary income for the year. So back when I worked with apartment syndicators, I would do what was in their best interest, and we'd take the cost, the depreciation when we needed it. So I would, in a perfect world, get their long-term capital gains income to be at $80,000. Why? Because if you've got no ordinary income, the first $80,000 of capital gains is taxed at 0%. And unfortunately, for some of my syndicators I did this with, they had trouble qualifying for personal mortgages on their houses because they didn't show any income. So even though they made tens of millions of dollars on paper, they didn't show income. And so at some point, it doesn't always make sense or they had to have, I know in one case, they had to have their mother sign on their loan, which was funny since they had an 8-figure net worth. How do you save money on your taxes when your W-2 is in the top tax bracket? So that's a great question. So one is maybe to become a GP on a deal where you are signing on the loan and you're actually more of an active role. And as a result, because of that more active role, maybe you make the case that you're more of a real estate professional and you get to deduct that. That still can be a stretch for some. W-2 income is the toughest to work with because there's not a whole lot you can do. And there's a reason why I love to focus on business owners, because there's a ton of tax strategies for business owners. That's also why I focused in today's presentation on stuff that almost anybody could do, which is the 401ks with the discounted rollovers and building those accounts quickly. That's why I also mentioned the infinite banking, because you're essentially not paying capital gains on any of the growth as you go. Was there a question, Dustin? No, I thought I heard somebody talking. Can I give an example of how depreciation loss is recaptured at the disposition of multifamily? So done poorly, it'll cost you big. Somebody is, I'm pulling up an example of how this might work. Legally, I don't have my depreciation example up in front of me, so I'm just going to tell it to you verbally. Let's say traditionally, most syndicators, most tax preparers, I should say, when let's say you do a deal with Dustin and he doubles your money. If we in that example, the syndicator is going to take that doubling of money and allocate it pro rata across all your assets. So let's break it down one level further that everybody can understand, take away the complication. You own a rental house that you bought for $100,000. 5 years later, you sell it for $200,000. Well, in that example, your CPA is going to say, you doubled your money. We're going to take that $100,000 gain and spread it across all your assets, including your $500 set of appliances. Well, you and I know that a $500 set of appliances, let's say that's a dishwasher. A dishwasher does not appreciate in value and grow by double. Instead, I, as a tax strategist and a good tax preparer, will go in and say, dishwasher, maybe it's worth $100. For others, they might take the case it's worth $0 or $50. And so if I say it's worth $100, my depreciation recapture is limited to $100. And then I've got the rest is at capital gains rates. Versus if I say my fully depreciated dishwasher is worth $1,000, I'm going to have $500 at depreciation recapture, meaning it's all recaptured at your ordinary tax brackets. So a lot of people like to say that depreciation makes investing tax free. I prefer tax deferred, because you got to recapture all that on the back end, unless you specifically allocate the purchase price, the sales price, and do some of the other things I've talked about.
Shit. Complicated, buddy. Complicated. Whoa.
Cool. Any other questions in the chat box?
Thank you.
You're welcome.
Cool. Well, if there's no other questions, really appreciate you being on, Keith, and we'll make sure that that your a recording will be sent out on this. So really excited about it. This, like I said, this is probably our basically every call we're on with an investor, they ask about taxes. So
well, it's the biggest bill you'll ever pay in your life. So the more you can do to shrink that is a huge help for your wealth and everything else you can do.
Yeah, absolutely. One question I did see, Annie had asked if you had the slide of the opportunity zone, you could throw it back up, Keith.
Sure, let me do that. I'm kind of flipping through so people can look through these later on their own if they really want. It's exciting stuff. I actually really enjoyed talking about taxes more from the perspective of all the different options that are out there. If you learn how to control this tax bill, you've got a significant competitive advantage over your peers.
Awesome. Well, cool. If you want to throw your contact info back up, and if there's no other questions, we'll go ahead and wrap it up and call it a night. So been looking forward to this one. We've been like I said, we're asked about this quite a bit, so appreciate your time, and we'll have the recording out, and yeah, appreciate everybody coming on.
Thank you.